10%. That is the penalty the Roth IRA's hidden 5-year rule can add to an early withdrawal, even though you already paid income tax when the money entered the account. And there is not one 5-year rule. There are two. They solve different problems, and confusing them can wreck the bridge between the day you stop working and the day you reach 59 and a half. The Roth advice you have heard is not necessarily wrong. Tax-free growth is valuable. Qualified withdrawals are tax-free. The problem is that most retirement advice quietly assumes you retire around 65. At that age, the early distribution penalty has disappeared, Medicare has started, and retirement accounts are easier to access. If you want work to become optional at 45 or 50, the same advice can leave you wealthy on a spreadsheet and cash poor in real life. The word Roth describes a tax treatment, not a single account. A Roth IRA and a Roth 401k can hold identical investments, display identical balances, and produce very different tax results when you withdraw money. Then Roth conversions introduce a separate clock, while the pro-rata rule can make a supposedly tax-free conversion mostly taxable. I read IRS Publication 590B, the Form 8606 instructions, the designated Roth account guidance, and the distribution ordering rules. They are not written for humans who enjoy sunlight. So if you want the person reading those documents before you move your retirement money, subscribe. It is cheaper than learning tax law through penalties. The first mistake is treating a Roth IRA and a Roth 401k as interchangeable. A Roth IRA is an individual account that you establish. You control the provider, the investments, and the withdrawals. Regular contributions can be withdrawn at any age without federal income tax or the 10% early distribution penalty. The IRS considers those contributions to come out before conversions and earnings. A Roth 401k is an employer plan account. The plan document controls when money can leave. Being your money does not mean the plan must distribute it whenever you request it. The usual restrictions applying to the employer plan also apply to its designated Roth account, including restrictions based on employment status, age, hardship provisions, and the plan's available distribution options. There is an outdated comparison that refuses to die. Roth 401k accounts used to require lifetime required minimum distributions, while Roth IRAs did not. The Secure 2.0 Act eliminated lifetime required minimum distributions from designated Roth accounts for tax years beginning in 2024. Current IRS required minimum distribution guidance confirms that neither Roth IRAs nor designated Roth accounts require withdrawals while the original owner is alive. Some IRS comparison pages were still displaying the old rule after the law changed, which is mildly reassuring if your retirement plan depends on government websites updating at the same speed as the government changes the law. The current distinction is not lifetime required distributions. The differences that matter to an early retiree are withdrawal availability, distribution ordering, and how earnings are allocated. Imagine your Roth 401k is worth $200,000. You contributed $120,000, and investment growth created the other $80,000. Your account is 60% basis and 40% earnings. If the plan permits you to take a non-qualified withdrawal of $50,000, you cannot tell it to send you $50,000 of contributions. The distribution is generally divided proportionally. $30,000 represents basis, $20,000 represents earnings. The earnings portion is included in taxable income. And if you are under 59.5 without an applicable exception, it can also face the 10% additional tax. The same $200,000 inside a Roth IRA follows a different ordering system. Your regular contributions are treated as leaving first. If you have at least $50,000 of undistributed regular contribution basis, that withdrawal can come out without federal income tax or an early withdrawal penalty. The investment statement may use the word Roth in both cases, but the tax code does not care about the marketing label. You can often roll a former employer's Roth 401k into a Roth IRA, which replaces the employer plan's proportional withdrawal treatment with the Roth IRA ordering rules. But a rollover does not erase every restriction or turn all growth into contribution basis. The Roth 401k provider must report how much of the rollover represents contributions and how much represents earnings. There is another trap inside that rollover. Time spent in the Roth 401k does not count toward the Roth IRA's 5-year period for qualified distributions. If you already funded any Roth IRA in an earlier year, your existing Roth IRA clock applies. If the rollover creates your first Roth IRA, its qualified distribution clock begins with the rollover year, even if the workplace account had existed for much longer. This is one reason opening and funding a Roth IRA early can be useful, assuming you are eligible to contribute or have an appropriate conversion strategy. The 5-year period begins on January 1st of the tax year associated with your first Roth IRA funding event. If you make a contribution in April for the prior tax year, the clock can begin on January 1st of that prior year. That brings us to the second mistake, believing there is one universal Roth 5-year rule. The first clock determines whether Roth IRA earnings can be part of a qualified distribution. To qualify, the withdrawal must occur after the 5 taxable year period and after you reach 59 and a half, die, become disabled, or meet the limited qualified first home condition. The first home rule has a lifetime limit of $10,000. The word "and" matters. Reaching 59 and a half does not automatically make Roth earnings tax-free if your Roth IRA has not satisfied its 5-year period. Satisfying the 5-year period at age 40 does not make earnings freely accessible either. You need the time requirement and a qualifying event. Suppose you open your first Roth IRA at age 58, fund it, and withdraw earnings at 60. The 10% early distribution penalty generally no longer applies because you are older than 59 and a half. But the earnings may still be taxable because the 5-year qualification requirement has not been met. Age removes one problem. It does not rewrite the definition of a qualified distribution. For an early retiree, the ordering rules usually delay that problem. The IRS aggregates your Roth IRAs and treats non-qualified distributions as coming from regular contributions first, conversion and rollover amounts next, and earnings last. You are not choosing which share or fund was sold for tax purposes. The ordering rule operates across the Roth IRAs you own. If you contributed a total of $80,000 over your working years and have never withdrawn any of that basis, the first $80,000 distributed from your Roth IRAs is generally treated as regular contributions. The account might now be worth $300,000, but the contribution records determine how much clean basis is available. Your brokerage's current balance page may not preserve 20 years of contribution history in a convenient box. Form 5, 4, 9, 8 records, tax returns, prior account statements, and rollover documents become important. The IRS knows what the ordering rule is. It does not promise to reconstruct your basis because you changed brokerages 3 times and recycled the paperwork. The second clock applies to conversions, and this is the one capable of creating the 10% surprise. When you convert pre-tax money from a traditional IRA to a Roth IRA, the taxable portion is included in income for that conversion year. The conversion itself normally avoids the early distribution penalty. Congress allows you to move the money, pay ordinary income tax, and place it in the Roth environment. But if you are under 59 and a half and withdraw taxable converted principal before that conversion's 5 taxable year period expires, the 10% additional tax can be recaptured unless an exception applies. You already paid ordinary income tax during the conversion year. The penalty exists to stop you from using a conversion as an immediate escape hatch from the normal early distribution rules. Every conversion receives its own 5-year clock. A conversion in 2026 has one clock. Another conversion in 2027 has another. They do not merge into the original Roth IRA qualification clock, and they do not all become accessible 5 years after your first conversion. The clocks use tax years rather than 5 anniversaries. A conversion completed in July of 2026 is treated as beginning its period on January 1st, 2026. Its 5 taxable years are 2026 through 2030. The converted amount generally clears that penalty clock on January 1st, 2031. This creates the Roth conversion ladder, but we are not at the fix yet because the IRS ordering sequence can change which conversion you are considered to have withdrawn. After regular contributions leave, conversions come out on a first-in, first-out basis. The oldest conversion is used before a newer conversion. Within each conversion year, the taxable portion comes before the non-taxable portion. Earnings remain at the back of the line. Imagine you have $30,000 of remaining regular contributions, a $40,000 taxable conversion from 6 years ago, and a $50,000 taxable conversion from 2 years ago. A withdrawal of $60,000 uses the $30,000 of contributions first and $30,000 from the older conversion next. Those amounts can avoid tax and penalty. A withdrawal exceeding $70,000 begins reaching the newer conversion, where the 5-year recapture penalty may become relevant. This is why the balance alone cannot tell you what is available. You need layers, undistributed regular contribution basis, each conversion year, the taxable and non-taxable pieces of those conversions, and earnings. A Roth IRA is displayed as one account but taxed like a stack of deposits with timestamps. The third mistake is assuming you can choose exactly which dollars are converted from a traditional IRA. This is where the pro-rata rule ruins the clean version of the backdoor Roth story. You may have heard that a high-income earner can place after-tax money in a traditional IRA and convert that contribution to a Roth IRA with little or no additional tax. That can work when there is no other pre-tax IRA money. The complication is that the IRS looks across your traditional SEP and simple IRAs when calculating the tax-free percentage. Suppose you already have $93,000 of pre-tax money in a traditional IRA. You add a $7,000 non-deductible contribution, giving you $100,000. You then ask the brokerage to convert the new $7,000. The IRS does not accept the claim that you converted only the after-tax contribution. Your basis represents 7% of the combined amount used in the calculation. 7% of the $7,000 conversion, or $490, is treated as non-taxable basis. The remaining $6,510 is taxable conversion income. The other $6,510 of basis is not lost. It remains attached to your traditional IRA pool and can reduce taxation on later distributions or conversions. But you did not achieve the nearly tax-free transaction that the phrase backdoor Roth tends to imply. Form 8606 performs this calculation using the relevant distributions, conversions, and the year-end value of all covered IRAs. The December 31st balance matters. Moving the non-deductible contribution through a newly opened account does not isolate it from a separate pre-tax IRA at another brokerage. An employer, 401k, is generally outside this IRA aggregation calculation. That creates a potential planning move. If your employer plan accepts incoming rollovers, you may be able to transfer eligible pre-tax IRA money into the plan while leaving non-deductible IRA basis behind. This requires accurate records, a cooperative plan, and careful execution. Moving money first and discovering the tax treatment later is not a strategy. The pro-rata rule does not destroy an ordinary conversion ladder funded entirely with pre-tax money. In that case, you expected the conversion to be taxable. It damages strategies built around the assumption that you can select after-tax IRA dollars while ignoring a larger pre-tax IRA balance. Roth is not an investment, and tax-free is not a complete retirement plan. The important comparison is the marginal tax rate you pay when money enters the Roth against the tax rate you would pay when it leaves a traditional account. An early retiree may have high income working years followed by several low income years. Paying the higher rate in advance can destroy the tax arbitrage you worked hard to create. The mainstream financial model says to maximize retirement accounts, invest for decades, apply a withdrawal percentage at retirement, and wait until the normal access ages. That framework can work for someone collecting a final paycheck at 65. It does not answer how you buy groceries at 48 when most of your net worth is trapped behind account rules. The financial advice industry loves the Roth slogan because it is emotionally easy. Pay tax now, never worry again. Your brain prefers certainty over an unresolved future tax bill, even when that certainty is expensive. Most money mistakes are not math problems. They are brain problems disguised as responsible decisions. If you value finance explanations that separate comfortable slogans from the rules underneath them, subscribe. The boring footnotes tend to contain the expensive part. Knowing these rules and building a retirement system around them are two different jobs. That gap is why I built a digital book called The Exit Code. It takes 50 years of actual retirement data and distills it into a mathematical framework for exiting the rat race on a specific date, rather than hoping your account balance eventually feels large enough. It covers the 4% trap and the dynamic withdrawal method that replaces a fixed spending rule when markets refuse to cooperate. It also explains the $14,000 invisible bill created by the insurance gap before 65, because a conversion plan that ignores health coverage can manufacture a new problem while solving the tax problem. The Exit Code costs less than 1 hour with a mediocre financial advisor and is available through the link in the description. Every year you delay the calculation removes another year of flexibility from the result. The Roth conversion ladder is where access planning and tax planning finally meet. It is not a giant conversion, and it is not a method for avoiding income tax. It is a schedule of deliberate taxable conversions, built early enough that each one becomes available when you need it. The latter needs a separate source of spending money for the first 5 tax years. That source might be a taxable brokerage account, cash reserves, Roth IRA, regular contribution basis, part-time income, or a combination. Without that first bridge, a conversion started after retirement cannot fund the day it begins. The conversion is planting food for 5 years from now, not opening the refrigerator tonight. Consider someone who retires at 47 with $900,000 in a traditional IRA, $350,000 in a taxable brokerage account, and $100,000 in a Roth IRA. Of that Roth balance, $70,000 represents regular contributions. During the first retirement year, this person funds living costs from cash and the taxable brokerage account. They convert $40,000 from the traditional IRA into the Roth IRA. That $40,000 is added to taxable income for the year, but the conversion itself is not hit with the early distribution penalty. The following year, they perform another conversion based on their tax situation. The amount might be $40,000 again, or it might change because investment gains, dividends, contract work, deductions, and health insurance calculations changed. A good ladder is recalculated annually. Repeating the same conversion amount because it looked tidy in a spreadsheet 5 years ago is how planning becomes ritual. After the first conversion's 5 taxable year period expires, that converted principal becomes available without the recapture penalty. 1 year later, the second rung becomes available. Each annual conversion is designed to replace part of the taxable account spending as the bridge progresses. The withdrawal ordering rules still apply. If the Roth IRA contains unused regular contribution basis, that basis comes out before the matured conversions. This does not prevent the ladder from working, but it changes your record keeping and the exact layer being distributed. The earnings generated inside the Roth are not the planned ladder withdrawals. You are moving converted principal through the 5-year waiting period. Treating the entire post-conversion account value as available would mix principal with earnings and reintroduce the qualification problem. The conversion amount should be designed around more than the federal tax bracket. Conversions increase adjusted gross income. That income can affect health insurance premium assistance, the taxation of capital gains, deductions, credits, state taxes, and later Medicare premium calculations. A conversion that saves $3,000 in federal income tax while costing $4,000 somewhere else has not saved money. This is the part most Roth ladder diagrams remove because it makes the diagram ugly. Your spending and your taxable income are not the same number. You might spend $60,000 while showing much less taxable income because part of the cash came from savings, return brokerage basis, or qualified Roth sources. You can then use some of the remaining tax bracket capacity for a conversion. The taxable brokerage account is critical because it gives you control over both timing and character. Selling an investment returns a portion of your own cost basis, while only the gain is considered for capital gains taxation. Assets held long enough may qualify for long-term federal rates. There is no retirement age requirement and no 10% early distribution penalty. That flexibility is why maximizing every tax-advantaged account can be counterproductive for an early retirement target. You can end up with an impressive net worth and an underfunded bridge. A traditional account buys a deduction today. A taxable account buys access. A Roth account buys future tax control. You need the combination that matches your departure age. If you intend to retire at 57, your bridge to 59.5 is short, and the rule of 55 might provide access to the 401k associated with your final employer if you separated during or after the calendar year you turn 55. That exception does not automatically follow money rolled into an IRA. If you intend to retire at 42, the bridge is more than 17 years. Roth contribution basis alone is unlikely to cover it, and a conversion ladder still leaves the opening 5-year gap. Your accessible assets deserve the same attention as your total assets. Paying conversion tax from money outside the retirement account generally preserves more capital inside the Roth. If part of a distribution is withheld for tax, and therefore never reaches the Roth, that withheld amount can be treated as money distributed rather than converted. For someone under 59.5, the taxable portion not rolled over may face the early distribution penalty unless an exception applies. A direct trustee-to-trustee conversion also reduces the risk of missing rollover deadlines or having mandatory withholding apply to an employer plan payment sent to you personally. The cleanest transaction is usually the one where the money travels between custodians while you handle the tax bill separately. The latter should be coordinated with your investment allocation. The money expected to fund near-term spending after a rung matures should not depend entirely on the stock market being generous during that exact year. Tax structure does not eliminate sequence of returns risk. It gives you another lever for managing it. There are other ways to access retirement money before 59 and a half, including substantially equal periodic payments and certain penalty exceptions. They solve different problems and carry their own restrictions. The conversion ladder is attractive because it can create flexible annual access after the waiting period without committing you to a rigid lifetime payment calculation. 3 records keep the system honest: your cumulative regular Roth contribution basis, your conversion history by tax year, and every Form 8606 reporting non-deductible IRA basis or Roth activity. Add the plan documents for any Roth 401k you intend to roll over. Your brokerage statement is an investment record, not a complete tax history. The fix then is not converting everything or funding Roth accounts at the expense of every other bucket. It is working backward from the year you want employment to become optional. Calculate the accessible money needed for the opening 5 years, estimate annual conversion capacity during low-income years, and leave enough flexibility for taxes, health coverage, and market volatility. I have multiple hundreds of thousands of dollars invested, and more than 10 years of running a business around accountants and fiscal lawyers taught me the unglamorous lesson. Money is often won through sequencing. The account, the tax year, and the order of operations can matter more than finding another fund with a prettier chart. Lazy investing built more fortune than crypto memes. But lazy planning is different, because the IRS will follow its ordering rules even when you never learned them. The Roth is powerful when it serves your retirement date instead of dictating it. Build the 5-year runway before you need the exit, because freedom delayed by a tax clock is still delayed freedom. D, the exit, because freedom delayed by a tax clock is still delayed freedom.